Okay, welcome back. Picking up where we left off. Where we left off was that we had 40,000 preferred shareholders, which was calculated as $2 million worth of preferred stock divided by $50 a piece, right? So that gives you 40,000 shareholders. Each one of those 40,000 shareholders wants their dividends. They want their dividends, which is 9% times $50. Every single person holding a $50 share of stock expects to get their $4.50. So 40,000 shareholders at $4.50 apiece, your preferred dividends are going to be $180,000. Okay, so now if you put this into the formula, you've got equals, you've got your net income of $480,000 minus your preferred dividends of $180,000, all divided by the number of common shareholders. Okay, well let's talk about that for a second. Now we're issuing $2 million worth of common stock at $10 a piece. In the previous one, we issued $4 million of common stock. Now we're issuing $2 million of common stock. So $2 million divided by $10 a share gives you 200,000 shareholders. So there's your calculation, 480,000, your net income minus your preferred dividends divided by number of common shareholders. Your earnings per share number is $1.50. Okay, third scenario. Here we go. Plan 3. Let's issue a little bit of all of them. So right off the bat, we're going to issue, in this case, we are going to have bond interest. So we've got 12% bonds. We've got $2 million of them. So what that's saying is we expect to have to pay out $2 million times 12%. We expect to have to pay out $240,000 worth of bond interest. Okay, so we had earnings of $800,000. Then we had to pay out some bond interest of $560,000. I'm sorry, we had to pay out some bond interest of $240,000. That leaves us with earnings before taxes of $560,000. I'm sorry, I'm the typical accountant. I can't do without these underlines here. It's making me a little crazy to look at the spreadsheet without them. Okay, so here we are. Oops, and of course I put them in the wrong places. Let's try that one more time. All right, now I'm happy. All right, so here we are, and we've got $560,000 is our earnings before taxes. So now let's pay taxes on that money. $560,000, our tax rate is 40%, so $560,000 at 40% is $224,000. Let's make that a negative. So our earnings before taxes are $560 minus the taxes of $224. Where we are right now is we are at $336,000 of net income. Now you can see in this scenario what's happened here is it's left us with less money to work with to run our business with because we are paying out that bond interest. So whereas before in the previous two scenarios we had $480,000 worth of net income, now we're down to the $336,000. And if money is tight, if actual cash flow, if we want to show a higher net income number, then this is not going to do us much good. Okay, so let's talk about the preferred dividends. This is the net income number we start off with in our earnings per share calculation. Let's look at the preferred dividends. Well, in this case, before we issued $2 million in preferred dividends, now we're issuing $1 million in preferred dividends. So $1 million in preferred dividends at $50 a piece. So how many does that equate to? So we've got $1 million, I have enough zeros, one more zero, divided by $50 a piece. We've got 20,000 preferred shareholders. Again, each of them expect to get their $4.50 worth of dividend, which is 9% at $50 par. Oh, it just wants to round for me here. What we are expected to pay out then is $90,000 in preferred dividends. So our numerator looks like this. Equals $336,000 worth of net income minus $90,000 in dividends, preferred dividends that is, divided by number of common shareholders. Okay, well that's changed too. We've got $1 million in common stock at $10 a piece. That means we have 100,000 common shareholders. So our earnings per share number is $2.46. So if a high earnings per share number was important to us, then by all means plan number 3 is going to be the way we want to go. But if we're more concerned about having operating income to work with to build our business and have money to work with, then this plan 3 is not the best option. Maybe plan 1 or 2 are the better options. Okay, the point is that you have to do these calculations in order to decide what is the best option. Without these calculations, you have no idea what it's going to do to what issuing stock versus bonds is going to do to your bottom line, and you don't know what it's going to do to your earnings per share numbers. Okay, so now that we've looked at it that way, let's get back to the PowerPoint. Oop, I have to move this around. Hold on a second. Okay, as you can see, there actually is a slide in here that gives you the same thing that I just did, but I gave it to you with a little bit of explanation, and you saw the calculations. But the information is here in this slide as well. All right, and yay, we come out to all the same numbers: $1.20, $1.50, $2.46. Now this was all predicated on having $800,000 of pre-tax and pre-interest earnings. Now here's the thing: if you were to change that earnings number, say to $440,000. Okay, so you're starting off with a lower number to begin with. You're starting off the beginning calculations of $440,000, and you're doing all the same work you did before. What's going to happen is it's actually going to reverse our earnings per share number. Earnings per share is going to be much higher under Plan 1, where you had issued only common stock, and it's going to be much lower over here under Plan 3, where you issued bonds, preferred, and common stock. Interesting, right? So you can't just say automatically, well, issuing all three things is the best way to have a good earnings per share number. You do have to run the numbers to see what it's going to do. And the reason why this winds up being so low is because you're not working with a lot of money here. You're saying you only have $440,000 of earnings before interest and taxes, and you're taking out a big chunk of money. You're taking out $240,000 to pay off that bond interest. All right, so when you're working with such a low number to begin with, you have to pay it out to bond interest, and then you have to pay out preferred dividends on top of that. Your numerator is so low, and your common shareholder number is so high that it drives down your earnings per share number drastically. Okay, so you have to run these numbers in order to see what it's going to do for your business and what is the best way to raise capital. Okay, let's talk about a little bit of terminology here. The agreement between the people buying the bonds and the people selling the bonds is called the bond indenture or bond agreement. Okay, that's the contract between them. Where in that bond indenture and bond agreement, there's going to be some information noted. First of all, it's going to have the principal amount of the bond, or basically how much is being loaned. So usually it's an amount of $1,000 amounts, or $10,000 or something along those lines. It's not going to be for some random amount in between those. It's also going to be stated on the bond some sort of interest rate. And usually, if there's not, there's something called discounting that we have to do, but let's not worry about that just yet. But usually there's an interest rate stated on there, and it also states in the bond indenture agreement, how often you're going to be paying out that interest. Are the bond holders going to get interest paid annually, semi-annually, quarterly, and so on. Okay, a little bit more terminology. If you have all of the bonds mature at the same time, which is quite formidable if you think about it, right? You're loaning out, you're getting $10 million, you put out $10 million in bonds in the world. If you're going to have to pay all those $10 million worth of bonds out in the same time, they're called term bonds, okay? They all mature at the same time. You're going to have to pay out $10 million, and that's one heck of a balloon payment. All right? If you spread the dates, the maturity dates, the date that you have to pay back the bonds over several years, it's called serial bonds. And bonds that might be exchanged for other securities are called convertible bonds. What that means is you could have a bond that if the bondholder decided, you know what, I don't really want to hold this bond anymore. Instead, what I'm going to do is I'm going to exchange this bond for 10 shares of preferred stock. All right, that might be, if that's an agreement written into the bond, then that's something that people are perfectly within their rights to do. All right, so they could say, you know what, we don't want this bond anymore, company, and instead we want to have those preferred shares. Then that's fine. They can convert it to those preferred shares, or they can convert it to common shares. They can convert it to some other security. The point is that information, again, would be stated in the bond indenture agreement. Callable bonds. Now, if we are the corporation and we're issuing these bonds, we might maybe decide that we don't want to have all these bonds due 10 years from now, and we might have a little bit of extra money laying around. If that's the case, the corporation might decide, you know what, I'm calling those bonds back in. I'm going to not let you hold that bond anymore. So I'm going to reach out into the world. I'm going to say, I'm going to buy back your bond, and your bond. And I'm going to give you your money back right now. All right, so, it's within the company's rights to do it as long as it's stated, again, in this bond agreement that they have this feature of this callable bonds. Like I said, the only reason I could see that they want to do this is because they don't want to have these huge long-term liabilities outstanding when they have money to pay them off now. All right. Most bonds are issued based on the reputation of the company. All right, and those are called debenture bonds or unsecured bonds. The idea here is that when you buy, say, a Microsoft bond, let's say they had a bond issuance, you would buy it, and because you're comfortable with Microsoft and you're comfortable with the company, you would buy into these bonds, and you're basically putting your faith on them that they're going to pay out the interest and they're going to give you your money back at the end of the period. That is a debenture bond. It's an unsecured bond. The alternative to this is what's called a secured bond or a mortgage bond, which is not listed here. A secured bond or a mortgage bond, a company is actually putting up a piece of collateral against the bonds. They might say, I'm going to put up this building against the bonds. In the event that I don't pay, the building is yours. Okay, so what they're doing is they're putting up collateral. They're securing the bond agreement. A newer company or a company that's not so established might have to do this in order to get the money that they want from raising bonds.